Good morning, traders. Sorry about the delay in getting started today. Happy Monday to all. It's 8:04 a.m. coming at you from Chicago on the 12th of March, 2018. Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results. Coming into the market today, the overnight session breached the 2800 century figure. Remember, this is expiration week. This Friday is quad witching Friday. So what do we expect this week? We're expecting a lot of volume, unusually high volume as we get into expiration. And remember, calendar spreads. These are orders that are designated as a future time spread. Take priority in the queue over your outright trade based on a timestamps. So you could be the first in line in the futures, and if a spread, a previously entered or spread that has an earlier timestamp allocates an order to your price on one leg of its spread, that price is going to trade to them, not to you. Just remember that. So you may see some stuff that may look weird, but it is expiration week. Also, as we push into the week, there will be, because futures are what they are, it is a hedging instrument. We'll get a lot of delta hedging of options, option positions, and futures are used for that. So we may see some anomalies in the way the market trades. It often gets pegged around a price, and it looks like it's going to break out, but just doesn't. In any case, this morning, the market again pushed to 28.05 and a quarter overnight. And has fallen back through. It's trading well beneath the 2800 century figure right now in the ES. Most markets are strong. I'm seeing better prices across the board versus Friday's settlement. The only ones that are lagging are the euro, which is down 14 pips. Gold down $5.40 or 0.41, and crude is down to $61.42. Down 62 cents or 1%. Allocations to risk this morning. Let's take a review of Friday. I didn't do a trader bite. Had some issues, some techie issues. Basically, what we've done is we gapped up. We've gapped up and we ran. So it's a gap and go type of day on Friday on really strong non-farm payroll release. We've been in a consolidation zone for a little bit of time, and we finally blasted through. The SOC, or the scene of the crime for the non-farm payrolls, is 2738.50. That is where the auction got interrupted by the news. And Fridays is a classic trend day. We have more than doubled the IB. We have a thin profile. We have poor counter rotations. We have many HVNs going up the trail. And we close near highs with the point of control at highs. So we expect, based on Friday's close and the poor high on Friday's close, we expect a continuation. The expectation for me was 27.99.5. It went to 27.99.75 and just hung out there for most of the overnight session until it pushed through to 2875, which was kind of interesting. It just didn't seem like it ran that many stops. So that's where we are. We ended up trading higher. The overnight low, if you might have noticed, is the closing price. 27.88 is the overnight low, and it's also the closing price. The overnight session, so there's not much to say here other than we left a gap zone behind Statistically, if we leave the gap zone behind after the initial balance is in and we have range extension up, we are very, very unlikely. Again, as always, past performance is not necessarily indicative, but we're very unlikely we'll test lower. So if we have a gap zone, so this is a gap zone. What is a gap zone? A gap zone is the space between the current low after the gap, the lowest price after the gap, to the highest price of the previous session. So the high of the previous session, which was 27.45.50, this is the gap zone here. If we don't completely close this within the first hour, there's a low probability of it being closed during that session. And Friday falls into that. Again, Friday's characteristics are for a trend day up. The higher time frame was definitely active. Very poor counter rotations for those who are trying to sell this thing on Friday. Probably didn't work out too well. So that's where we stand. Volume on Friday, not so great for the pit session. The overall session had almost equal volume. June versus March. Remember, we're in a rollover period here. But the pit session only had 700,000. This again is affected by rollover. But the overall rally did not have all that much volume in it, whether it's in March or June. Okay, that takes us into the overnight session. The overnight session had standard volume, 117,000. I just ran a quick study. The most common overnight volume is now 100,000. The value area of overnight volume on the high side is 300,000. So everything below 300,000 is considered normal, although 300,000 doesn't occur that much, and it's being affected by February's high volume on the overnight. So 100,000 to 110,000 is normal. So what we have here in the overnight session is a very high kurtosis profile right in the middle, and we are testing right below the point of control, the mid VWAP of the overnight session after pushing to 28.05 and a quarter. I have a stock zone at 28.0575. Again, the stock zones are just areas where I'm looking to interact with the market. This is a very obvious, but somehow it eluded me until a member pointed this out, that I can throw these bands on here instead of having them on paper on my desk. I can throw them on here just like flex levels. So stock zones are based on price action, just traditional support resistance. They're also based on volume profile, and then they're also based on statistics. And these are the areas that I'm looking to stock for the day. So I'm not going to spend too much time on them, but essentially it's where I'm looking to interact. I don't interact in the middle of the zone in between unless I see something that just short term that has just formed based on market behavior. So what is the overnight saying? It's saying we tested higher, we found sellers, we saw a pretty quick drop to the mid, and then from the mid we couldn't break back up above 2,800, and now we're continuing lower. So this looks like it is likely to be responsive. The overnight inventory is long. You can see here the prior day's low is the prior day's close, which is how we measure the overnight inventory. It's basically the overnight inventory is where are we relative to the prior day's close. So the overnight inventory is long, and it's some rebalancing somewhat. Okay, so if we push into the prior day's range, so you can see we pushed up, pushed back into the stock zone, on the edge of the stock zone, up to 28.05 quarter, back into the stock zone, and now we're trading back into it again. And so the expectation is if it pushes into the prior day's range as part of Friday's trade, we're likely to push down into 2780, 2780.50 or so. That area, that stock zone looks to be about 2.5 points, just a standard stock zone. Anyway, so that's where we are on the overnight. Now, I want to just make sure to reinforce, this is my internals chart. This is monitoring the S&P net volume, advanced decline, the New York stock tick, cumulative tick, and the S&P net issues. And you could see that the S&P net issues on Friday just was strong throughout the day, just pushing out of 500 stocks, 417 were positive. The advanced decline ratio is very strong for the advanced side. Again, I only monitor the S&P 500 here. I don't monitor the New York Stock Exchange for these numbers. Net volume was very strong to the upside on the underlying stocks. So it's just a lot of indication that we don't want to short this. Okay, so the biggest indication to me was the inability to get into the prior days. Our president tweeting prior days range. Here's what we did last week. Let's collapse this. All right. So last week we started out down here, and last week has been an exercise in one-time framing, mainly with the gap on Friday, with a gap and go on Friday. So last week is really a clear indication that the higher time frame stepped in and that the rally has resumed. Remember, the NASDAQ and others, the NASDAQ has made all-time highs. So the S&P is relatively lagging, and we're going back into these gap zones that we've left behind from a while ago, from the end of January. So we are pushing into this range. You can see how thin this trade is, so it's very easy to slice through. As long as we maintain above the gap zone, we are likely to test the next gap zone up in the 28.14 area and then regain 28.33, consolidate. This is all longer term. This is this week into next week, consolidate, and then get into the next gap zone for all-time highs. And then we would have very little to contend with to get to the all-time highs from there once we get through 28.45, 28.50. So that's how we're set up. Okay. As far as what I'm expecting today, and I do have a few words, so I'll try to get through this quickly, about this darn statistic about 80% of traders fail. Just really bothers me to quote that statistic just blindly, as a recent article from someone who's very well respected had done. This morning, I'm expecting an open auction. Okay, so the market's likely to, because we did have a balanced overnight profile, we are we are out of range. I'm expecting an open auction out of range. I'm expecting us to push through into the prior day's profile, and then I'm looking for us to consolidate for a quick pop, and then I'm looking for us to stay up here. So today's profile is expected to be pretty Gaussian and balanced, and I expect us to hold above 27.77 for the session. Okay, so overall, I'm expecting a drop into the into Friday's range to complete this auction. Remember, a trend day says that the participants could not find value. That's what trend means. Essentially, the participants kept advertising higher prices, 27.80. Anybody selling at 27.80? No. 27.81? No. 27.82? No. All the way up to 27.92, and then it ran out of time. And when it runs out of time, the market closes. We have this closing bar, this down bar, because a lot of the volume that goes through the exchange is based on margin. We have a closing bar, and then the auction's interrupted with the point of control near highs. That's why when the market resumes, we expect the auction to continue to seek that seller. That's why we move up. We're looking for sellers. The market is looking for balance all the time. And so I expect that we would temporarily find balance here. And if we do, then we're likely to test the opposite side, consolidate. That's the primary hypothesis or scenario. The secondary scenario is an open auction that dips in, gets impulsive higher, and then starts to consolidate near the overnight high, and then ends up responding. So I expect a consolidation in the overnight high, and then I expect this to consolidate again. This would mean we would be consolidating higher. Okay, so that's what I'm looking for today. With regards to this issue of 80% of traders failing, there's a study that was done that keeps getting cited again and again. And I just want to say that this is a performance sport. So if you're looking to be a world-class soccer player or tennis player, but you are in an environment where you're not around other world-class soccer players or tennis players, and you're just kind of muddling along, there's no accountability, there's no focused, deliberate effort, and so on, then yes, you will fail. So these studies that basically collect data from brokerages and look at how many people have deposited money, opened an account, deposited money, and ended up closing an account, that's a failure, or having to redeposit money, that's potentially also a failure. I have to reread the study, the white paper on it. And those things are measured as failures. So to me, if I was learning to be a surgeon and I'm doing it at home and I keep killing my little frogs as I perform surgery on them, or rats, or whatever you want to use, without the guidance and the structure and the accountability and the deliberate intent, plan, and everything else, then yeah, you're going to fail. Okay? And 80, 90% will not be surgeons. And so the same goes for trading. It's no different. This is something that is going to test you to the core. I've had many, many traders come along and say, I'll get this. I've been good at everything I've done. No problem. And my answer is always, you will learn about yourself, because it's a level playing field, especially in the futures. There's no place for you to practice live. You are out with real professionals who are here all day and trade hundreds of thousands of dollars in their account, and you're coming in with $2,500 or $5,000 or $10,000 for the same opportunity. And most of the time, these people are not being provided with good structure, continuing learning and accountability, and so on. So yeah, I expect 80% to fail. But my experience in my own prop shop is better than inverted that statistic. All but one trader passed, succeeded. My measure for success is finishing a 3-year prop contract and then continuing to trade past it. So to me, I just don't agree with that statistic. You got to put the statistic into context. This is not impossible. It is very difficult. Okay? It's simple, but it's not easy. Remember that. It's simple, but it's not easy. So if you're here to entertain yourself, to gamble, to bet, and you lose your money, and that's your intent, fantastic. Fantastic. And you will be part of that statistic. But if you are here because you want to leave your job or you want to support yourself with trading, then that requires a whole different level of participation and a whole different level of how you practice, what you practice, and how you track. Do you really log every trade? Do you really plan every trade? Because that's what it freaking takes. That's what it takes. You're gonna have to know what you're doing wrong on every single trade. Sometimes it's just luck, right? We expect and take losers quickly because that's just part of the process. But if you're sitting here trying to do every little thing to avoid a loss, and then once you engage with the market, and only if you believe that it's not going to lose, and that's when you engage with the market, you have locked yourself into a loser. Okay? Remember, you are just tossing dice every time, tossing a coin, really, every time. You're just tossing a coin. And the goal is that you only toss when the probabilities are stacked in your favor, but in the end, it's just a coin. Okay? And when you're looking at statistics for win percentages and profit factors and Sharpe ratios and Sortinos and all this stuff, it's all history. It's in the past. It has no impact on the current trade. Just remember that. And so when you take the current trade and you close it, it becomes a part of that history. You need to understand and document what you did. If you did what you planned to do and you have an edge, which most people do, believe me, it's not that hard to find an edge, then you just move on. You document that, you see how it impacts your goal, you reset every weekend, and then you come in and you deliberately practice not committing those errors, which add up to a lot of losses. So I'll leave you with that. It's just a very irritating subject for me because it discourages people, tells them that this is impossible when it's just very difficult. And they have to have the right attitude and come in with the right expectations. Good luck.